Hello everybody, May is typically a good dividend month and 2023 is no exception. So this year I got a bit of a dividend bonanza, especially given that I bought Capo and OCBC earlier in the year. So these guys also gave out pretty good dividends. So this month I was uh, seeking good opportunities in the REIT space to reinvest the dividends, especially given that I sold a bunch of REITs already. So I'm a bit underweight in the REITs in my portfolio. So I was looking to replenish the weighting actually. So as mentioned in my previous video, I sold all my REITs in the STI index already. First time in 18 years. I think the STI is gonna go through a big correction subsequently end of the year. So I didn't want to be holding all this stuff. Anyway, I'm not impressed with the REITs in the STI index. I talked about it in the previous video. With the exception of MIT and MLT, I'm not impressed at all. So I was looking for cheap plays to buy. First thing is of course CLCT, which I mentioned in the previous video where I bought at 1.04. I also mentioned that it's quite likely that the short sellers will just target the big round number of 1. And of course it happened on the last day of May. So I bought, I think it's too cheap. It's ridiculously cheap. Look at the charts, dude. It's back to where it was in the COVID lockdown period in China. I think the short sellers are just targeting China like crazy, man. You look at the daily trading volumes for CLCT. On certain days, the short selling volume is more than 50%. More than half of the volumes are just short. It's not just CLCT though. The China plays on SGX are all getting shorted upside down. Capitaland investments getting shorted. What the other China plays? I think Nano Film with stuff in China also getting shorted. What else? Yang Zijiang Financial Holdings, which is a pure China play, shorted upside down. The entire Western Hemisphere, the media, the politicians are all just trying to screw China as bad as possible to crush its economy. Especially given the Taiwanese elections coming up, I think the rhetoric against China is just going to get heavier and the drums will be rolling to screw China as bad as possible. But I think this is just too cheap and I just have to buy something. Why buy more CLCT if it breaks 1 and goes lower? Perhaps, but perhaps not. Because if CLCT hits to what 90 cents, I think the rest of the stuff in the Hang Seng Index will also get hammered and killed massively. And if that's the case, maybe it's good to just go to Hang Seng, Hong Kong Exchange, and buy some of the stuff over there, which is trading at very very cheap valuations. On SGX, CLI is also getting hammered, so maybe I'll buy some of that as well. So let's see what happens. Also bought some Capitaland India. Look at the share price, boom, back to where it was in 2020 again. I'm not sure why people hate the CL's cleaned so badly. Maybe because people hate the Indian rupee. Maybe because people are worried about the work from home impacting on their business park occupancy. Maybe people are worried about the equity raising because of the acquisition pipeline they have, which is pretty substantial. I don't know, but I think it's very cheap. So given that I'm quite underweighted in the REITs, I just bought more. I bought Starhill Global, which of course have gone back to where it was over here, where I bought at 50 cents. This is just way too cheap. Tourism is coming back. Wisma is probably gonna do pretty well. So is Nian City. I think this is just way too cheap. I bought Paragon REIT at 93.5 cents, which is higher than where it was last year. But I thought this is a potential privatization play. I think my guess is that the CICT might make a play for Paragon REIT. So if you go to the REIT mall and you look around, you notice that the malls are now onboarded into the Capital Star program. So I think that's a big precursor for a privatization of Paragon REIT by CICT. So in the meantime, I can collect the 5.5% dividend yield, right? So I get paid to wait for privatization. I'm not sure if it will happen and what terms it will happen if it happens. But I get paid to wait for that to happen, right? So okay, not bad. I bought Far East Hospitality Trust at 60 cents in mid-May, and well, too bad everything just collapsed again at the end of May. Now the offer is still at 60 cents. You can buy as much as you want. The seller is very happy to sell you everything. I think this is stupid. Tourism is gonna come back to Singapore. Hotels and service residences are gonna pick up RevPAR and occupancy, and the DPU is gonna grow quite decently, I think. I also bought the MIT back, which is a quite happy thing for me because I already sold all my REITs in the STI index, and in my previous video I also mentioned, right, for all the stuff in the STI index, all the REITs in the STI index, I'm only impressed with MIT and to a certain extent MLT. the rest of the stuff in the STI index, I'm just not interested at these valuations. I think those stuff will have to correct by what, 10 to 15%, at least 15% for me to be interested. So I'm not interested in the rest of those stuff. I'm quite impressed with MIT though, especially given the recent placement. The demand is still very, very strong, and I think they've done well. They did not upsize their placement. So very trustworthy, right? You see some of the other REITs, they do a placement and tell you they're gonna issue X amount, and then if the demand is okay, actually even if the demand is weak, they just upsize anyway. I think it's irresponsible. I think this guy is very, very responsible, especially now that they've finished the redevelopment of the Kallang development. They just stopped the DRP as well. So I think these guys are still very, very responsible managers. And look at the dynamic of the data centers in the US. I think the dynamics are still very strong. Now you have this resurgence of AI, and I think the big cloud providers are just gonna rush to occupy as many data centers as possible, because all these data centers will now occupy the servers that are needed to host the IOM models, the generative AI tools, and with the graphics cards from NVIDIA. I think the data centers in US is still gonna undergo very, very positive demand. So I'm quite positive on this guy actually. I last sold the REIT at 2.35 over here, so now I buy back 2.24. Just a small discount to where I last sold, especially if you think about the dividends that were distributed after I sold it. But nonetheless, I'm still buying back cheaper than what I would have if I held on to the REIT. So I'm quite happy actually to buy back this stuff. And now I'm not completely out of the STI index anymore. I now have MIT, which is a component of STI. So actually, I'm quite happy buying this stuff continuously. So if this stuff continues to correct, I'll buy more actually. I'll continue accumulating this stuff for the foreseeable future actually. So if you look at the tabulation of the REIT and their fundamentals, so the first three REITs, I think it's a no-brainer. Yielding more than 7%, I think. This is the trailing 12 months of the DPUs. So with a 5 to 7% impact on the DPUs, which I foresee for most of the REITs in Singapore, given the rise in interest rates, the high yield right now is enough to compensate for the decline in DPUs in the next 1 year, I think. So these guys are still yielding very, very high. So I think that's enough compensation. For Paragon REIT, it's just a 5.8% yield, trailing 12 months. But I think this is a privatization candidate, right? So I get paid around 6% while waiting for an offer, which I think is attractive. So MIT, I talked about it before. The 6% yield looks a bit low, but I think the dynamics in the US data centers is still very strong. So maybe they have rental growth and so on and so forth. And anyway, if you look at the contribution from the Kallang cluster redevelopment, I think those stuff is going to give a big DPU boost even after the capital distribution stops. Maybe I'll talk about MIT subsequently in another video if there's some request for it. Far East Hospitality looks quite low, right? The yield is just 5.5% amongst the six. But look at the first quarter numbers. The income available for distributions actually jumped by 24%, right? And you can expect this will happen because now the hotels and the service residences are now trading above the minimum rent, right? So with the improvement in the tourism sector, I think the DPU will just rise. So although the 12-month trailing 12-month DPU is just 5.5%, I think going forward, this is gonna increase by at least 15%. So probably gonna yield around 6% or even more if the tourism sector continues to pick up steam. So these are the stuff that I bought in May, and going forward, there's still a lot of things going on. Like Ames Capital recently raised a preferential offer. I haven't decided if I would subscribe to the rights issue, but maybe I will. And more importantly, I think a correction will come in the August to October period, especially now that the debt ceiling is now approved. So I think the Treasury will now start issuing treasuries and therefore soaking up liquidity, drying up liquidity, and therefore after that the stock market will just correct because fundamentally, not fundamentally, nowadays the stock market is just about fundamentals. There's no the stock market is just about liquidity. There's no fundamentals involved anymore. So I think we're gonna have a correction subsequently, and I'll buy back more of the stuff, especially the blue chip components of the STI index, especially MIT.